Okay, so welcome to part three. This is our macro outlook, and obviously there's lots to talk about, especially with the debt ceiling potentially agreed. Okay, so over the weekend, the debt ceiling, it's still dominating. Now, there seems to have been an agreement in principle. So the element there, the key point there is in principle. It's still got to be passed by Congress. Now, that's probably likely to happen Wednesday. And to be honest, the vote it's not a guaranteed done deal because there's going to be plenty on both sides that are going to be unhappy with those compromises. Saying that, the pressure's there because they've got to get a deal done basically by the 5th of June, which is X Day. Otherwise, they're going to have to start defaulting. And not only that, but of course, there's the risk that they'll get downgraded by the agencies as well, and they'll lose that AAA status. So the details so far for this agreement seem to be non-defence flat for 2 years and then to rise by 1% in 2025. Lift the debt ceiling for 2 years until after the next election. There'll be a time limit on food stamps up to the age of 54, although there will be some exceptions. Now, after that, sort of the actual size of the increase hasn't been released yet while I'm recording this. And, we've got to remember, so at the moment it stands at $31.4 trillion. Now, I looked back, and if you go back only 15 years, it was less than $10 trillion. And of course, we've heard sort of that when we're looking at that, there's potentially not going to be any new taxes. Government programs, there's probably likely not to be any new government programs in those plans either. The overall cutting on spending year on year is going to be sort of set. And that's going to be sort of a 1% top line number for the next 6 years at 1% growth. The bill also looks to include pay-as-you-go. Then that's going to sort of mean that Biden needs to find offsets, regulations, rules, etc., around any increase in government spending. What it seems to be to me is there's, overall, okay, you can change where you spend your money, but you can't increase what you spend. And of course, the IRS agency will be very unhappy because their funding request has been slashed. It would also recover tens of billions in unspent monies during COVID that was allocated. So, it's useful. And I expect, maybe Monday sometime, if not before that, everything will be revealed on what has been agreed. But just remember, just because it's agreed, it hasn't been passed yet. And, we've heard from lots of central bank speakers over the last week. And the various Fed ones have given very mixed views on what their expectations of rates. Some not keen to add any more increases. Others sort of looking for more increases. Although, I would say probably Friday's PCE data, again, remember that's the Fed's preferred inflation data. It may just force the Dubs to vote for one more 25 basis point hike next month. Again, we just have to sort of see the rest of the data that's coming out this week to how that's going to go. Now, one of the problems I'm seeing is manufacturing. It seems everywhere, it just seems to be under pressure. And you've seen that highlighted in all the PMIs from last week. Now, the dollar had a much better week. The Dixie was back over 104. And I think one of sort of the other highlights last week, it certainly helped S&P and the Nasdaq, was Nvidia that outperformed, and them close. It got the S&P and Nasdaq closing the week very strong. Of course, that risk on and that stronger dollar that we saw last week also pushed gold down, and it actually sort of tested the 1940s. Oil was pretty quiet, I would say. It was in a sort of pretty much a fairly tight range. Now, just going back to the PCE data, inflation hasn't dropped. It's struggling to go down. It's become very sticky. In fact, it popped back up a little bit. And, when you look at some of the data that's in there, cars, used cars, all of that, and demand is still there for them as well. But I just don't believe that inflation's going to get down to where the central banks want it. And it's not really surprising because there's so much corporate greed out there at the moment, especially, as I keep saying, in the food sector. They're compensating for lower sales with higher prices. And, especially when you come to the food sector, especially chocolate, I'm a chocoholic, but that shrinkflation is rife. If you look at a Mars bar from years ago, I mean, it was almost like a meal, and now it's almost just like a bite size. I'll probably need about 3 of them just to sort of satisfy me for a while. So, there is still an argument for central banks to accept a higher target rate based on a lot of this. I've mentioned it before, this sort of 3% on a temporary basis, and there seems to be more economists that are sort of muting the same point that why not? After all, it's not a perfect 2%. Is just something that was picked out of the air by a New Zealand politician, then enforced by their head of the central bank, and then adopted by other central bankers over the years. Now, again, I just don't think that all the full impact of all of these rate increases that we've had to date, as we haven't seen that fully impact the economy and the data yet. So that takes months and months and months to feed in. And then of course on top of that, we've got this sort of little bit of a credit squeeze going on, with lenders cutting back after the recent bank crisis. And if this debt ceiling is agreed, then watch out, because just watch those banks, because if it is all agreed by Congress, then Yellen has a lot of issuance to get done before liquidity dries up over the summer months. So she's got lots of departments to pay back, but it could really pressure the overnight rates, because banks will need to keep within their cash reserve requirements, and it'll probably mean that the Fed may have to act as lender of last resort again to prevent a spike. That happened the last time the Treasury went into overdrive, issuing a load of short and long dated treasuries, because the overnight rate just popped. So of course, as just mentioned, Yellen needs to sort of repay the cash siphoned off from other departments in recent months to keep the lights on. And not only that, but she's going to have to sort of get ahead of the game as well, because of the summer months coming up. So she's going to do a lot of issuance in my mind. And then the big question is she really going to have enough funding to get her through till 2025? Now we're still seeing sort of recession dangers, and that was perfectly demonstrated by Germany, as it's now entered a technical recession. And for me, that could become entrenched even deeper, with the ECB committed to continuing to raising rates in the short term. Now, as I keep mentioning, these central banks, they consider a recession a price worth paying to sort of regain control of inflation again. It's much easier for them to reboot the economy than it is to fight inflation. ultimately, it's for me, what's going to beat inflation is not so much the rate hikes, it's going to be the prices themselves, because we as consumers are going to start cutting back more and more. It's the only thing I can see as a solution. And although inflation did drop back into single digits in the UK, that's where I'm based, it is still higher than expected, and above many of its peers. Again, it's going to sort of leave the Bank of England little choice in my mind but to hike rates further. So I'm just going to move on and just touch on the war. So Russia hit Ukraine over the weekend with a massive drone attack. This is all building up for a new offensive by both sides. And now I want to come back to Nvidia, because all the talk at the moment, everywhere you look on all these chat things, is about AI and chat GPT. It certainly boosted Nasdaq pretty much all of last week. So when we look at the stock markets, they're doing amazingly well considering, but profit margins are up, so you can get it from that point, but they are, if not going to start to be selling less. So in my question is, can stocks keep climbing when consumers are cutting back due to the higher prices? However, that said, again, if you look back at the UK, retail sales bounced back last week. Again, it just goes to show how resilient the UK consumers can be. Now, when we sort of look at this week, there's lots of data out, and we're going to get further insight into, the potential for another June increase from the FOMC, because we've got the JOLTS data, ADP data, and NFP data coming out. So it's all about the jobs. And of course, the big question is going to be, really, can they pause, or will there be another 0.25%? Now, just sort of, again, just a little reminder, when it comes to the NFP, I focus much more on the hours worked and sort of the wages. And the reason for that is because they're the inflationary elements. As I mentioned earlier, with unemployment at half-century lows, for me, it just doesn't have much meaning at the moment, unless or until, of course, that starts to rise, and then I will be much more interested in it. Okay, so again, just a reminder, in case you skipped the first two parts, we provide a daily newsletter full of global news to help you prepare for the day. And of course, fresh daily chart levels and pivot points are available too. If you are looking to get into trading or improve, then one-day workshops. If you really want to sort of feel competent and confident after just 1 week, then our 1 week course can do that for you. We've added an additional course that also gives you a free chance to qualify for a funded trading account. And as I always say, in a week, if you've got an inner trader, I will help you find it. And if you're really serious about trading or turning it into your career, then our comprehensive accredited masterclass has been designed to do exactly that. We're going to provide you with all the knowledge and trading skills required to just sort of get you going and really build those deep, solid foundations to navigate any market in any conditions and any asset class. If you're already trading but you want a little bit of help to get boosted to that next level, or maybe you want to learn a different asset class, then we can help you with that. And if you work for a company that has perhaps some FX exposure or commodity exposure, we can provide you with some solid yet flexible hedging strategies. When it comes to trader education, We provide it to individuals, exchanges and brokers. And of course, we've got funded trading account opportunities through our partner, and there's a link to that. If you've got any questions whatsoever, or you would like more details, then reach out to info@cymaxfintech.com, or if you've got any trading questions, you can aim direct to me, I don't mind. So it's chris.tubby@cymax-int.com. And of course, I hope you'll stay with us now, because we're going to move on to the technical analysis.